Good morning, everyone. Welcome to today's Phillip Securities Research Morning Call. Today we have several stock counter updates. For results, we have CDL, Thakral, Soilbuild, Evergreen, Frencken, CNMC Goldmine, Nordic, Hyphens Pharma, Sheng, PropNex, and ComfortDelGro. For Phillip on the ground, we have Zoom, Namcheong, UI Baostate REIT, Yangzijiang Shipbuilding. And for update, we have SETS. We'll end up the session with SG Weekly for week 11, as well as our monthly outlook for March. Kindly note that there will be no technical analysis as Zane is on leave. Yeah, so I see some technical TA questions, but we won't be answering TA questions today. Yeah, thanks. This is a disclaimer slide. Any information provided is solely for educational purposes and not financial advice. Without further ado, let us move on to our next speaker. Thanks.
Hello, good morning, everyone. So I'm presenting Zoom Communication Phillip on the ground. Next slide, please. Next slide, please. Okay, thank you. So I think it is a company that everyone is familiar with, right? So the company provides enterprises with professional video meetings and collaboration tools with their client. So market cap at 20 billion, slightly undervalued at the moment, with a forward PE at 13.2 times, which is lower than 1 year average at 13.9 times. So looking at the revenue, the top line was driven mainly by the enterprises revenue. So they got retails, they got enterprises, but enterprises has been growing by 7% year over year, higher than the just retail, which is flat year over year. So enterprises making about 60% of the total. We are seeing the numbers of customers making larger deals, larger than $100,000 deals, is growing at 9% year over year. So mainly based on the product, it's because of the Zoom Workplace, which is the all-in-one collaboration platform where you get within the Zoom Workplace, you get Zoom meeting, Zoom team chat, Zoom call, calendar, and all in all. So the enterprises has been buying because of mainly Zoom Workplace and all. So especially with the recent artificial intelligence integrations, which you can do more than just having call and all. So enterprises have been buying. Look at the financials, the earnings nearly double, 88% year over year higher at 1.9 billion. So two factors. First is operating income, higher operating income. That was coming from cost discipline. The cost declined by 3% year over year. The second is from strategic investment that they made. So they have this one particular fund called Zoom Venture Fund, where they invest in mainly startup that builds technologies or products that might be helpful to Zoom's product and ecosystem. So one of the highlight of the strategic investment is Anthropic. So they have minority stake in Anthropic. So back in 2023, they invest about 51 million in Anthropic. So at the current market right now, where the market suggests that Anthropic, this value that they have, it might be worth about 2 to 4 billion US dollar. So that increase the value of the strategic investment that they have, hence the higher earnings. So as a benefit of Anthropic, cloud system is now running throughout the Zoom product set. For the outlook, revenue is expected to grow by 4% year over year, slightly higher than a year ago. But the free cash flow is expected to be lower. First is because of the refreshing database, the cost of the infrastructure capital expenditure, which is not AI capex, but just for infrastructure capital expenditure for them to refresh the database. And then lower interest rate, and also now they are thinking of doing more cash-based compensation instead of stock-based compensation, hence a lower free cash flow expected. Higher enterprises expected from the higher pricing on the SKU, which is the premium pricing package of their product, while at the same time they're maintaining low churn, because we are seeing that their net dollar retention is at 99%. That means that people are renewing their contract with Zoom, as Zoom is providing more AI added value product. And for AI monetization, now they are prioritizing AI into core business, which is their premium SKUs, mainly on Zoom Workplace and Zoom Meeting. So for AI features, like you could generate meeting summaries, you could create follow-up action after the meeting. And for Zoom call, for example, Zoom phone call, generate voicemail summary. For the trending right now whether the AI startup could replace Zoom. We don't think that AI model could replace Zoom anytime soon because enterprises prefer reliability and security for critical function, which is meeting the client. So you need to work every time and build in security for confidentiality. So we also expecting larger deals growth, centering around the contact center, which is function is to reroute customer call to enterprises to call Zoom. We are seeing that a lot of the deals now is including AI features and models. And Zoom phone call, the annualized recurring rate is continuing to grow at mid-teen. That's promising. And also the AI features functioning across the portfolio. So that is all from me. I will pass over to the next presenter. Thank you.
Thank you, Fahmi. I'll continue with C Limited. So C Limited just released their earnings last week. Next slide, please. So their fourth quarter revenue was in line with expectation. Their PMI underperformed because they're elevating investment, especially in the Shopee side. FY25 revenue and PMI were at 103 and 89% of our estimate. So basically, all three segments show very strong growth. On the Shopee side, GMV grew 29% year on year for the latest quarter. They're continuing to strengthen its ecosystem. They're scaling up their logistics and focusing on initiatives like their Shopee VIP membership. Management is also guiding continued strong growth of 25% GMV growth in FY26. But they also mentioned that the EBITDA growth will be flat because they're investing a lot in the logistics and trying to subsidize on their loyalty program. So that is why that is what sent the stock price crashing. On the financial arm, their loan principal grew 80% year on year, driven by very strong user acquisition, deeper engagement, and broader credit user case. They've actually managed to boost their new credit users up by 40% year on year because they're shifting from a whitelist model to a everyone can apply approach. And engagement also improved. Their average loan outstanding per user was up 27% year on year because they're now offering higher limit and longer tenures for users with strong credit history. They're also trying to expand their off-Shopee loan, which increased 300% year on year. Despite the aggressive expansion, their 90-day NPL ratio remains stable. It's still at 1.1%. So, because they say it's supported by the improving underwriting model that leverage ecosystem data and AI. The gaming side, also very durable and monetizable at scale. It's been 2 consecutive years of more than 30% year-on-year booking growth for Free Fire. They have very strong content execution and major IP collaborations, and they're also encouraging tractions from new titles like their new EA Sports. So for guidance, management expect double-digit growth in their bookings for gaming for FY26, supported by continued momentum in Free Fire, and they have some upcoming IP collaborations as well. And also because this year is going to be the FIFA World Cup, so they're also running a lot of football-related promotions. And like I mentioned just now, they're also getting 25% year-on-year GMV growth for FY26 in Shopee. So overall, very strong operating momentum across its ecosystem, particularly within Shopee and Money. Their guidance also indicated sustained demand and healthy platform engagement. The market reacted cautiously because of they saying that Shopee earnings won't grow, but we believe this reflects a very deliberate choice to reinvest in key areas such as logistics, infrastructure, fulfillment capabilities, and user growth initiatives, which is what helps them to stand out to their competitors. So in our view, these investments should further strengthen their positioning and support long-term leverage as their scale continue to build. So in terms of recommendation, we maintain our buy recommendation. We roll over to another years. We actually decreased our PMI by 1% to account for the increased investment in e-commerce. Our target price remain unchanged at $170. So that's all from me. I'll pass my time to my colleagues.
Yeah, thanks, Helena. Yeah, run through CDL's results. So unlocking value through faster recycling. Yeah, next slide, please. Yeah, so for the results, it was above our expectations. That's mainly because of the super capital gains from divestments that they made, especially from the South Beach sale. So looking at revenue, it's up 9.7% year on year. So this is supported by the very strong property development segment in Singapore, which rose 24% year on year. So that is supported by developments like the Ori and Siong Grand. As well as the divestment of the Ransom Wharf site also in London, as well as the divestment of the the Suzhou Hong Kong City Center office component as well. So all these help to so-called increase revenue 9.7% year on year. But for the PBT, the PATMI or profit before tax, the performance is boosted by the capital gains. Yeah, like I mentioned, especially from the sale of the South Beach. Yeah, so for the positives, in FY 2025, they recorded a very strong residential sales. So it was a record high for CDL at 4.35 billion. So that compares to 2.97 billion in FY 24. And in the pipeline, they have 1,820 units in the launch pipeline. So that includes the Tanjong Rhu site that they recently acquired. And in the second half of this year, the Lakeside Drive is expected to launch. So altogether, they have 1,820 units. And for divestments, in FY25, they made 2 billion divestments. So this includes the South Beach sale. And they made 1.7 billion in investments. So that they recycled these proceeds into investments. And this 1.7 included 3 GLS sites and 1 hotel in London. So going forward, they plan to continue the divestment strategy. So they have this legacy UK development sites and residential projects that altogether valued about 800 million Sing dollars. So they plan to divest this year. So these development sites, they were acquired somewhere between 2013 and 2017. So they have underperformed. So they are looking to kind of divest this, if possible, divest this full UK portfolio, which is 800 million in this year. As well as they're looking to divest the China underperforming commercial properties also, but remains very weak in China. So likely they will, if they manage to divest, will likely be at a discount to valuations. Yeah, so for this year, they indicated that they'll revise their dividend policy to a minimum of 35% of reported PATMI. So in FY25, they paid 28 cents. So total, it was a 40% payout. So this amount, 35% reported PATMI, includes gains from divestments, and is so-called it's a positive signal because previously they didn't even mention any number of the percentage of payout ratio or anything like that for dividend payout previously. Yeah, so going forward, the outlook is that we expect Singapore residential sales to remain very strong, especially we've seen their first launch this year, Newport Residentials, the ultra luxury project. It's already 66% sold to date. And for their hospitality segment, it remains very stable. So we saw RevPAR growth of 1.3% year on year in FY25. So we expect it to remain kind of similar, barring unforeseen circumstances like this Iran war. So the war might impact some travel demand in the near term. For Singapore, commercial remains very resilient with high occupancy of almost 98% for both office and retail. Yeah, CDL, right now, they're also undergoing a strategic review. So the review outcome will likely be out by June 2026. So we are looking at more firm divestment targets as well as fund management initiatives that could possibly involve recycling assets into private vehicles or private funds. Yeah, so for FY25, their gearing was 71%, but that's mainly because they took on loans to pay down the GLS. The GLS sites that they acquired. So in the medium term, they're looking to reduce that to 60%. Yeah, so we maintain our buy call. Our target price increased to $11.32. So it's a 25% discount to our NAV. And yeah, like I mentioned, they paid 8.28 cents dividend, which is a 48% payout ratio in 2025. Yeah, next slide, please. Yeah, so I'll run through Thakral Corp. So multiple levers for growth in 2025. So for the performance in FY25, it was exceeded our expectations, but that's mainly from the gain from the listing of the two spin-offs, so-called Gem Life, as well as the Beauty Tech Group. So these two, Gem Life and Beauty Tech Group, listed last year. So they booked a significant gain. So Gem Life and the Beauty Tech Group combined after deferred tax net fair value gain, they booked in 128 million of gain last year. So that is basically the huge chunk of the PATMI that we see in FY25. So for core PATMI, so-called in the lifestyle business, which is mainly the Nespresso, beauty fragrance, and distribution of DJI products. So that was up 36% year on year to 14 million. Yeah, so going forward, they indicated that they expect the lifestyle segment, the whole segment, to grow by at least 25% year on year. Yeah, and they paid out a dividend of 6.5 cents, so that translates to about 3.5% yield. And our buy call is maintained, so our target price is higher after we so-called mark to market all these IPO gains and such. And based on the current share price of the Gem Life and the Tech Group, so it's now $2.56 at a 50% conglomerate discount. Yeah. Next slide, please. Yeah, so the next slide just shows an outlook of all their various business segments. So I'll just run through one by one the business segments. So for beauty and fragrance, which is they're selling fragrance products in Greater China. So right now they manage 65 retail stores. So they'll continue to expand its brand portfolio and for both the offline and online channels. So this is to capture rising demand in the region's beauty market. So they're also leveraging like all these social media influencers to help to sell their products through their online channels. And for DJI, they have an expanded range of drones, accessories, and audio visual products. So all these continue to gain traction in South Asia, and they are looking to so-called establish 20 to 30 new DJI stores. So that includes flagship stores over India and South Asian markets over the next 2 to 3 years. So this will help to so-called boost the traction for DJI as well. And for Bharat Skytech, which is a fully owned subsidiary, so they've pivoted into manufacturing components for agricultural drones. So they're expected to start manufacturing in May with commercial launch in second quarter 2026. So they are capitalizing on the Indian government's Make in India initiative. So they are bringing all the manufacturing back in-house to India. So it's likely that they can do that. They can start manufacturing drones as well, and likely start selling agricultural drones in India. So for Starlight Drones, right now they have a 23% stake. So they are exploring a joint venture with Starlight Drones to manufacture enterprise grade and specialized grade drones in India. So that is still very early stage. For Nespresso, they started out 2 years ago, in 2024. So going forward, they are opening new boutiques and pop-up stores. So they expect the Nespresso business to achieve profitability in 2027. So that is 1 year ahead of originally expected by 2028. And the Nespresso business continues to scale through its boutiques, their online platforms, and B2B sales, especially from the selling more espresso machines and the capsules. And for the Japan property investments, right now they have 5 Japan commercial buildings. So the average occupancy across all these 5 buildings are at 99%. So it's very strong occupied. It's almost full basically. And they have 1 hotel also. So this hotel right now in FY25 performed very well. So it's really hit the revenue share model instead of the base rent. So they are getting now 30% revenue share from the Best Western Hotel. So the Japan portfolio is currently provides stable recurring income, but it does offer potential for opportunistic divestment if the price is right. Yeah, and next is their biggest project that's upcoming. So this is the real estate project in Gurugram, India. So at the start of this year, they recently they recently entered into agreements to acquire an additional 81.64% stake in this 21-acre mixed-use healthcare-led development site in Gurugram for 94 million. So this 81% increased stake will increase Thakral's equity stake to 95.28% because currently they own 13.64% stake. So they acquired this 13.64% stake in end of 2024. So in 2025, they booked the 9.2 million gain on their initial stake. So the initial stake they spent 6 million to acquire it, and now it's worth about 15 million. So they recorded a fair value gain of over 140% in 2025. So currently this project is in the very initial stages. So currently it will comprise a hospital, So they are working with a tier 1 hospital operator to construct as well as operate the hospital. So Thakral will be entitled to a revenue share of the profits from so-called revenue share from the hospital when it starts to operate. And for the residential component, they are also working together with residential development partners to design and construct the component, the residential part. And the group is entitled to a share of the profits or area share or share of the residential unit sales. And so the last part will be the health and wellness center. So Thakral, they plan to develop and manage that asset themselves. Yeah, so overall, this project has a very strong potential to become a significant contributor to Thakral over the longer term. But any cash flow from this property, because it is still a barren land at the moment, so it will take at least 5 years. So you are looking at over 5 years before any cash contribution will start to come back into Thakral, like from the operating of the hotel and the residential sales. Yeah, so that's for Thakral, the outlook. Yeah, next slide, please. We move on to the UIB, UI Bao State REIT view on the ground. So this is just a very quick overview of the IPO. So the UI Bao State REIT, they have a market cap of 1.2 billion based on 88 cents. And the IPO, and currently their AUM is 1.9 billion. So it's an industrial REIT with 71% of AUM in Singapore and 29% in Japan. So their AUM is very similar to AIM's APAC REIT. Yeah, so for their public offer, basically they have about 30 million in value, so 33.9 million units at 88 cents. So after the IPO, the sponsor and Bao State projects will hold 19% of the total units. So the sponsor is a UIB. So UIB is majority owned by Macquarie Asset Management, Bao State, and Unified Industrial. So Macquarie Asset Management owns about 60% over, Bao State about 20% over, and the remaining is UI. Yeah, so looking at the dividend yield, they've guided FY 2027 dividend yield of 7.8%. So that's the chart at the bottom. So that if you compare it to their closest competitor, which is AIM's APAC REIT, we are looking at a forward 7% yield. So that's more attractive. And for currently Bao State UIB, UI Bao State REIT, they are having they're going to pay 80% of their management fee in units. So 20% is in cash. So that is better compared to the two recent IPOs that did last year for REITs, which were 100% of the units paid, 100% of management fee paid in units. Yeah, and for this 7.8% that they've guided a dividend, so it doesn't account that doesn't take into account that there's potential further upside from AEIs or acquisitions from the sponsors completed and stabilized pipeline. So I have that in the next slide, as well as co-developments. So currently their initial occupancy is slightly under 90%, but they are in close discussions, and I believe they've also finalized some of the lease negotiations, and it's likely that they will be able to increase their occupancy by 8%. So there will be about 87% in the near term. Yeah, so if you look at the bottom left side, that's the dates that you need to keep a lookout for. So the IPO is already open, so opened last week, and the closing date is tomorrow, 12 p.m. 10 March. So the Bao State REITs units will commence trading on 12 March. So if you want to apply, there's a snapshot from the prospectus of how to do so. So ATM, internet banking, and such. Yeah, next slide, please. Yeah, so this is just a quick overview. So it's a little bit small, but they have a few pipeline from the sponsor as well. They have co-development opportunities as well to co-develop together with the sponsor. So co-development opportunities generally will give a higher yield on cost. So it will benefit so-called the yield-wise for Bao State REIT. And looking at the debt maturity profile in the bottom left, they don't have any debt maturing. I mean, they were 40.6 million in FY 2027. Yeah, but other than that, is the next debt expiring is 2029, and for them, they have indicated that their weighted average cost of debt is currently at 2.4%. So they have intention the debt split is around 50-50, so half in SGD and around half in Japanese yen. So they've indicated they plan to hedge 50%, at least 50%. So, but most of the hedges will be in the Japanese yen. So 80% will be in Japanese yen. So that leaves the Singapore portion relatively mostly unhedged. So about 30% hedge for Singapore. Yeah, and the top right corner is their split of between their business segment and their whale profile also. So for single tenants, they have one expiring in 2027, but other than that, there's 2030. So they are trading at a price to NAV of about 1 time. So that is also more attractive than AIM's Fed Review is trading about 1.2 times price to NAV. Yeah, so that's all I have for UI Ball State REIT. Yeah, and return now to Hashim. Thanks. Sorry, to Iqbal.
Yeah, thanks, Darren. I'll be presenting on Soilbuild's second half results. So their revenue and PATMI exceeded our expectations. This is because there's greater contribution from their large projects. For example, the PSA Supply Chain Hub project. Yeah, so that's why it drove their PATMI to surge by 84% year on year. Soilbuild also turned net cash in second half. So this is because the increase in net income drove operating cash flow to increase 6.4 times year on year. And Soilbuild also had a higher dividend payout in FY25 itself. So the proposed dividends will increase their payout ratio to 31%. Last year was 18%. Yeah, so we estimate the yield to be about 3%. Yeah, which is quite impressive for a construction company. In terms of the negative for Soilbuild, their order book declined slightly by 15% year on year, but it's still significant currently at 1.07 billion. So as you can see at the chart at the bottom right hand corner, in FY24 itself, they were awarded a very big 650 million PSA contract in FY24. And in FY25 itself, this contract recognition, because of project progressing, it drove revenue and PATMI. And also because of that, the order book also dipped a bit. Because if you look at the normalized kind of private industrial contracts that Soilbuild can tender for, is about 200 to 300 million in the market. So the PSA contract is abnormal, is 600 plus million. Hence we do expect order book to dip going forward. But however, our outlook for Soilbuild is positive. We do believe that demand in the private industrial space will be strong because Singapore, the Research, Innovation and Enterprise RIE 2030 plan set aside 37 billion for the next 5 years for research and semiconductor. So this 37 billion is about 30% higher than the previous budget set aside for 2025. And because of this higher budget, we do think that Singapore, as it wants to set up Singapore as like the advanced manufacturing hub, we do think that EDB will bring in more companies to set up their manufacturing facilities. One example would be like Micron, which intends to set up their manufacturing facility in Singapore. And Soilbuild, with a track record of setting up high spec manufacturing facilities, we do think that they are able to tender and win further contracts like this. Yeah, so one example would be the Soitec manufacturing facility, which they have completed last year. For Soilbuild, we maintain buy. Our target price is unchanged at $1.40 because we roll forward our model, and we also decrease our PE ratio because there's a re-rating of the construction sector, so it balances out. That's why the target price is unchanged. Yeah, so that's for Soilbuild. Next up, I'll be presenting on Everglory's second half results, titled Guthrie Drives New Growth Trajectory. This is because Everglory completed the acquisition of Guthrie last year, and we are seeing the consolidated results coming in. Yeah, so their second half results exceeded our expectations. This is because following Guthrie's consolidation in second half 25, it drove adjusted PATMI up by 98% year on year. Yeah, so So the positive for Everglory is that the adjusted PATMI spiked, and uh, and also because the order book, I mean, another positive for Everglory is that their order book surged 135% year on year. Currently, their order book is 733 million, and this is because they have won several contracts. For example, Alexandra Integrated Hospital, that's about a 200 million order size. And also some contracts regarding the maintenance of street lighting in Singapore, as well as bus depot facility upgrades for M&E, for the M&E contracts. Our outlook for Everglory is positive. We do think that Everglory currently is like one of the largest M&E players in Singapore after the acquisition of Guthrie. So we do think that it can secure additional high value contracts going forward. As you can see, the BCA, the bottom right hand corner shows the chart regarding the contracts awarded annually, and BCA forecasts this to be at a very elevated levels for going forward for the next 4 to 5 years. So we do think that as contracts are being tendered out to main contractors, the demand will flow down to M&E players, and the largest M&E player will be Everglory. And the upcoming potential contracts we see for Everglory will be Changi Airport Terminal 5, LTA, MRT, tunnel lightings, as well as the integrated hospital contracts, which we do think there are 6 to 7 contracts over the next 2 to 3 years. And each contract can be about 100 to 200 million in order size. And for the Changi Airport Terminal 5 is regarding the runway lights. So to build the entire runway portion is about $1.1 billion. So if you take about 10% assumption for M&E contracts, then the order size can be about 100 plus million. We do think that this is a potential tailwind for Everglory. So for Everglory, we upgrade to buy with a higher target price of 1.05 as we roll forward our model to FY25 FY27's PE. Yeah. Next up I'll be presenting on Frencken second half results. Our title is Position for the Rebound in Semiconductor, because semiconductor results were soft in this half itself. Yeah, so second half revenue and PATMI is within our expectations. Previously, management already guided semiconductor results to be soft, so that's within our expectations. If we look at fourth quarter semiconductor revenue is down 4%. This is because their key customer ASML has recalibrated their orders from Frencken itself as they prepare for the high-NA EUV machine. But going forward, we do think that there will be a ramp coming in second half of this year as the high-NA EUV machines go into volume production. So we do think that will benefit Frencken. The positive for Frencken's results is that the industrial automation and medical segments continue to drive growth. We do think that industrial automation growth will sort of decline going forward because there's a very rapid ramp in terms of customers' orders from their data storage customers. So we do think that FY26 itself, the ramp will slow down. For medical segment, we do still see higher demand from China, from their key customer. So in terms of our outlook, we as mentioned earlier, we do think that the ramp will pick up this year and slowly have a bigger ramp in second half of this year itself. We do think that the demand is strong, especially as TSMC guided a 32% year-on-year increase in their capex, and 70 to 80% of it will be spent on advanced process technologies. So we do think that this will benefit Frencken's key customers, which are ASML and Applied Material. We maintain buy for Frencken. We raise our target price to $2.50 as we roll forward our model. And Frencken is currently still trading at a slight 10% discount to its peers PE. Yeah, so currently it's still considered undervalued. Yeah, so that's all for Frencken. I'll hand over the time to Hashim. Thanks.
Yep, I'll go through sets. Next slide, please. So for sets, their revenue and PATMI did quite well. Their revenue was up about 8%. PATMI was up about 20+%. and this is largely because of their cargo. So their cargo volumes increased about 7.3% year on year to 2.6 million tons. And the reduction in cargo from and to US lanes was made up by the Europe and APAC routes. And semiconductor and AI related time sensitive cargo continue to support demand. Apart from cargo volumes, they are also winning new contracts. So they won new contracts from China Cargo, Saudi Cargo, Azul, Allegiant Air. So these are new recent contract wins. And to support these contract wins, the company has also been focusing on capex as well as leasing initiatives. So they're building new built-to-suit facility in London as well as Frankfurt, and these are used to support their cargo operations in Europe. So negatives wise, their US ground handling team is under pressure. This is because there are lower cargo volumes with the current conflict and as well as the import tariffs, and so cargo volumes have been reduced to the US airports. SETS currently does cargo handling for or ground handling for 35 of the 82 airports it's currently in the US. And we believe some of these cargo stations were marginally profitable when it was acquired together with the WFS acquisition. And because cargo volumes are down now, they might have become a bit unprofitable for SETS. What SETS is doing to deal with this is that they are currently engaging in a pricing renegotiation, and they are trying to establish a minimum volume threshold to deal with the reduced volumes. So going forward, we don't think it would be a very significant issue for the US ground handling operations. Outlook wise, Q4 is expected to be the weaker quarter because seasonally it's the traditionally weakest quarter. And the Middle East conflict, we expect for cargo yields to tighten. They do have Middle Eastern customers, but we think it might not really affect their operations a lot because for these Middle Eastern airlines that they are customers of, they not only service them in the Middle East but across the globe, in the Americas, in Europe. So the reduction in revenue from Middle East might be marginal for them. Apart from that, new operations that are going to be coming online in the coming quarters will be their Pathum Thani facility. So this is a food catering facility in Thailand, as well as the Noida Air Cargo Logistics facility, which is expected to be very significant given that previously Delhi is the air cargo facility for India. Now up and coming is Noida, which SETS currently has a foothold in. So with this, we maintain a buy rating with the higher TP of $4.44, and SETS is trading at a PE or forward PE of 19.5x. So next, I will go through CNMC Goldmine. Next slide. Next slide. So for CNMC, their operations are very strong. Their revenue increased over 100%. PATMI increased about 14.6 percentage points. And for CNMC, their performance is largely tied to the gold prices. So we saw the gold price rally over the past year. And what CNMC did to capture this growth is to increase their production. So their carbon and leach expansion, which is just their chemically processed gold ore operations, have increased their capacity from 500 tons per day to 800 tons per day. So that's a 60% capacity increase. And that led to gold production in the second half, increasing over 65%. And this largely supported the PATMI increase of over 390%, as we saw in the second half 2025. And because of this increased volume in the gold production, their fixed mining costs. So fixed mining costs includes your lease costs, your security, your insurance. All of these are spread over a larger base of gold production, and that brought down their all-in sustaining costs, which is the cost to produce 1 ounce of gold, taking into account your direct costs as well as your capital required to sustain production. It fell over 7% to $1,491 per ounce. So we can see that for every 1% increase in production, AI, the all-in sustaining cost increases by much lesser, about less than a 1/10, and this leads to strong operating leverage for the company. So negative wise, they may have a potential tax payable of 7.3 million. This came about because of previously they used management fees as a tax reduction, but the Malaysian tax authority said that this is not allowed anymore, and so the management fee reduction that they had from 2019 to 2024, which amounts to about 4.6 million, might be payable to the Malaysian tax authority. We think the exposure is manageable given that their PATMI for second half itself was 32 million, whereas this total tax liability is 7 million only. They already made a upfront deposit of about 1.8 million, but yeah, we don't think it's going to be significant even if they have to pay the full amount. Outlook wise, we are expecting for volume uplift in FY26. So last year, when their carbon and leach expansion facility came online, it was only for a part of that year. For FY26, it's going to be for the full year. So we will likely see an increase in volumes. And apart from that, the so-called underground mining facility will also come online. So this is the second underground mining facility, and it's expected to come online in 2026. So apart from this near-term increase in production, they are also doing exploration at Newfound and Manson's Lode, which has a capex investment of about 12 million. So this we expect, if anything is found, will scale production higher from 2027 onwards. So we have a buy on CNMC with a TP of $2.34, and it's trading at a forward PE of 13.6x. So next I'll go through Nordic Group. Next slide. So for Nordic, their revenue fell about 16%, 16 to 17%, and this is largely because of the business model that Nordic is in. So Nordic is largely project-based, although they have a maintenance portion. In 2024, they had a lot of large projects that were contributing to revenue. In 2025, it was largely completed, so the contribution to revenue was no longer there. So as a result, their revenue fell. But PATMI wise, year on year, their PATMI increased about 19%, and this is because of a $3 million reversal of unused project contingency provision. So what this means is that when Nordic went to the Malaysian market for projects, they allocated a larger than needed provision or buffer because it's a new market for them. They didn't want to take any chance, so they had a larger than needed provision. And when the project completed, it completed below their cost of their required cost of sales, and so they were able to repatriate back this $3 million. So that allowed for the cost of sales to be lower. And apart from that, Nordic has also been aggressive in their debt repayment. Their financing costs for second half 2025 fell over 75%, and this allowed them to grow their PATMI over 19%. So now that most projects are done, Nordic is set for the next growth phase with its new project pipeline of projects. They have a sales pipeline of over 300 million, and defense makes up the largest portion of it. So what we like about their defense subsidiary in particular is because it's a very specialized department. So if you're going to do a project for a customer, you would likely be the company that's also doing the maintenance. And maintenance usually has a period of say 3 to 10 years. And so it's a long time period where they're getting recurring revenue from the maintenance contracts. Outlook wise, for their defense subsidiary and their fuel subsidiary, Starburst and Avon, both are going to benefit from near-term pipeline like the MMRC2 as well as the Paya Lebar Air Base relocation. And their semiconductor subsidiary, NVPure, is also going to benefit from Micron's Singapore expansion. Recently, we saw that Micron is building new facilities in Singapore, and Micron is a key customer for NVPure. So NVPure India will also be NVPO India will also likely expect its first orders from second quarter 2026. So it's a new market that they are going into for Nordic. So apart from these, in Thailand, Nordic is also working on an industrial battery system for a US-based customer for AI data centers. So they're currently waiting on a production license, and revenue contribution is expected from 2027 onwards. So we have a buy rating on Nordic with a TP of 63 cents, and it's trading at a yield of about 4.8%. So next, I will go through Nam Chong, Phillip on the ground. Next slide. So for background, what Nam Chong does is two main things. First one is their OSV, offshore support vessel chartering business. So all these oil majors that might need support vessels, Nam Chong lends their own fleet of vessels to them. So this is currently where majority of their revenue is coming from. The second one is the shipbuilding business. So Nam Chong started off as a shipbuilding company, but they transitioned or expanded towards OSV chartering. But their recent win in a shipbuilding contract of over $60+ million from a UAE-based oil major has put the light back into their ship building business. Financials wise, their revenue fell about 9.5%. This is because of normalized vessel utilization rate. So in 2024, their vessel utilization was about 80+%. Currently, it's about 60+. And their gross profit fell about 27+%. So this was because of two asset disposals. So they sold off two ships, and before they had to sell it, they had to do maintenance to make sure that the quality of the vessel is proper. So there was some dry docking and major repair work cost related to it, which increased their one-off costs. Adjusted PATMI fell at a much lesser pace, about 4.4%. And for outlook wise, we expect continued vessel sales as well as purchase, given that it's currently a seller market for Nam Chong. Nam Chong made it clear that they are willing to sell if a buyer is willing to pay about 5 to 7 years of future earnings. And so we do expect further vessel sales in the coming quarter. And we also expect vessel utilization to improve. So in 2026, we think increased demand will come from Middle East, Brazil, Guyana, as well as from their offshore wind market in Asia. And Nam Chong is trying to differentiate itself by building new types of vessels. So this includes their dive support vessel as well as their autonomous remote operated landing crafts. So with that, I will pass on to the next speaker.
Thanks, Hashim. So I'll move on to Hyphens Pharma. Hit the refresh button. For those who don't know, Hyphens Pharma is a pharmaceutical company. They have, and also proprietary brands are like Ocean Health. Next slide. Just a bit of description. When you say specialty pharma, basically these are pharmaceutical products that they will sell direct to the doctors for prescription drugs. In general. So the results was generally in line. I think the profit rebounded almost 30%. Although the headline, you will see that the earnings actually down because there was a lot of provisioning and so forth that they did. I'll explain later. But the one positive is that the gross margins really jumped significantly to 41.9%, almost 6 percentage points. And then the negative is they made more provisions. So if you go to the second last bullet point, so what happened for them, the refresh button, is because one of their big markets is Vietnam, where they sell to hospitals and all these specialty pharma products. But they had some inventory challenges, so they made huge write-offs in inventory, and then they had to deprioritize some of the products. What has happened is because of the strong euro and the weak Vietnam dong, they actually had difficulty or challenge passing on the higher costs. So that's why there's a refresh. But they still managed to control costs. You'll notice distribution, admin costs all came down, and that's what helped them to grow the earnings. Although it's not like a super large company, it's like 6 million. So we still raised our earnings by 10%. We maintain our buy. I think what is happening is that they continue to grow outside ASEAN. They are still trying to build scale. So the one challenge they have is they just lack scale. But of course, the gross margins is still attractive at 42% gross margins, even though they're not actually producing the product. But it also shows that distributing other companies' products that have better scale can hustle high margins. So one of the things they've done, just to go back again to the last bullet point, is that they actually managed to also grow first-time milestone to go into Europe with this Sarah Pro. This is their own product. And of course, don't expect a sudden surge. You still need to get registered in Europe and then still need to do a sales to all the doctors and so forth. But I mean, it's a milestone because it's the first time they're entering Europe with a distributorship. And the stock is cheap. I mean, talking about 8 times PE, 1/3 of the market cap is cash. But it's just a very conservative. Don't expect a very strong, ultra high, strong growth, but maybe like high single digits. But one thing good is that you're owning a branded company. So most of these distributorships they have is exclusive and they have their own brands like this Sarah Dan, Ocean Health, and so forth. Next slide. So for Siong, so more optionality in the store openings. So what we're trying to say is that, Siong is of course well known for having HDB stores, but the optionality now is they're beginning to see more shopping mall owners coming to them to open supermarkets in the malls. Of course, they know it's costlier, but they are getting good deals. That's why they're opening. Next slide. So for Siong, the earnings was generally in line. Another record in gross margin. So gross margins continues to be extremely strong, about almost 32. Largely because of the fresh products, which can be as high as 40%, I believe. And fresh product, it means that all the meat that you buy or fresh fruits, so the margins is quite high, which many companies find it hard to replicate at what they can do. The negative is same store sales. Same store sales means all this matured store, let's say the store in Ang Mo Kio, the growth is, I think if you look on the table on the left, is 1%. But that is the condition of the market. So don't expect like the Ang Mo Kio Siong store to have a lot of sales because it's matured. And probably the population in a lot of matured estates are shrinking. Yeah. So the key to grow is really to open new stores. Not just for them. I think you open a coffee shop also cannot, also have mature same store sales. So in terms of the outlook, we push our earnings just a little bit. We raise our target price. So we're moving our valuations even higher because it's really trading at 20 over times. So we're moving it to the higher quartile, about 25 times. After that, I'm not sure how to move it anymore because it's really at the 25 times target. But the growth will come. So the second last bullet point, they are growing the footprint. So it was a record year in new stores and they grew the footprint by 15%. So once you grow the footprint by 15, of course, not every store will contribute immediately. So this will give you the baseline growth when you go into 2026. Because when you open a new store, at 14% more stores. So, but all this will take time to load up the sales for new stores to grow. So this will give the earnings growth for next year because of the new stores. And the final bullet point is that they are opening stores in retail malls also, like we mentioned. This is an additional pathway to growth because for Siong, it's not about it's the ability to secure stores at good rates. So that's always been the challenge. But with competition abating, I think last year was a good year. They opened like 87 stores. Yeah. Oh, sorry, they opened 12 stores. Yeah. They have now 87 stores. Yeah, sorry. Yeah. Next slide. Yeah, so for PropNex, they report their second half, a year of consolidation. So what we're trying to say, this year don't expect very strong earnings growth. I think that's because there's a lack of new units for them to sell, new launches. Next slide. So the earnings was actually slightly below, I think because of the interest income and also lower margins. But they raised their dividends. The ordinary dividends almost doubled to 9.5 cents, or you can say like 100% payout. So they're paying like almost 70 over million in dividends. The positive is new home sales. So you look on the left here, revenue up 86%. That was mainly because of project marketing means new launch sales. And then they have very strong cash generation. Of course, they have net cash of almost 150 million. We lower our earnings, target price, we downgrade to accumulate because of the lower number of launches. So just to give you a flavor, last year there was about 11,400 launches. This year is only around 8,800. I'm excluding ECs. So of course, with fewer launch, then don't expect project marketing to be strong. And the resales market, all that, and so forth, probably like low single digit kind of growth. They're still paying like 4% yield, and that was on a 194 share price. Yeah, and also the net cash is about 150, and of course they are still the dominant leader. They did lose a bit of share in new home sales because when you do new home sales, when everything's sold out, right, it's all about balloting. So they might, I don't know, then depends on luck. But for them, they still dominate. They got 60% share of HDB resale, private resale, and also new launches. Next slide. So this is basically the outlook given by them. But just to give you a sense, so you look on the table on the left, new home sales. This industry, this is not PropNex. So the industry sales might drop 17% because last year sales was I think 10,004 or 10,006. So this year will drop to about 9,000 because, like I said, a lower number of new launch. In terms of private resale, it's expected to be flat. The one thing why the buyers who go to resale market, of course, prices are cheaper and also they can take advantage of the low interest rates. So because you can lock in the interest rates immediately, whereas you buy new is progressive. In terms of the property demand, where the demand is coming from, of course, the rise in population and new citizens tend to be of higher, I guess, economic value or higher salary. I mean, like a better word. So they can move on to property and then not face the ABSD. And number two, rising number of $1 million HDB resale. So this will also pave the way for the upgraders market. And then rising wealth. They're beginning to see more and more parents support. I wish I had it, but anyway, parents support that help buy property for the children. Consider it like a wealth transfer. So a lot of parents are doing that. They expect property price to rise maybe 3 to 4%. And just to give you a sensing of how much the market can go per square feet. Again, this is just a rule of thumb, left thumb, right thumb. But the mass market pricing, if not, you can call it mass market. But I mean, the highest price is around 2.5 million. Anything more, they find it very hard to sell a particular unit. So if you just assume the smallest unit a family can take, which is a 3-room, maybe 800 square foot. So you're talking about maximum. Again, this is maximum, about 3,002 square feet. Again, this is just some rough indication to understand the market pricing or dynamics, because 2.5 million is the ceiling for the so-called mass market. Next slide. Okay, ComfortDelGro fourth quarter results. So the big worry now is that the taxi fleet in Singapore is starting to decline faster than expected. Next slide. So the results was generally in line. I mean, 97%. The underlying earnings in the fourth quarter was down 2%. The positive is, of course, this has been the story for the last 2 years and should continue another two years or three. They are repricing their metro bus routes. So the buses in London were unusually weak at the margins. Now that competition has kind of abated, they can get back to their teens margins. The big negative is the drop in taxi earnings. So you look on the left here, the taxi and private hire, the earnings dropped 20%. We'll explain why later. So we are lowering our earnings, lowering our target price, and then the earnings will be supported again, like we mentioned, by the London bus and improving driver, and also they secured more Manchester bus routes and some Stockholm. But the one that is hurting them is actually going to be in Singapore. So they lost one more bus package. I think it's the Jurong one, and the fall in taxi fleet is going to be a major pressure point. But they are paying a yield about 6% at $1.42. Next slide. So just to give you a sense, so if you look at the table on the left, the red line is the taxi fleet. So in 2024, in 2023, the taxi fleet was generally stable, was flat. Then 2024, it dropped a bit, about 4%. But 2025, it really started to collapse, especially in the fourth quarter, where it's dropping almost 9 to 10%. So of course, mathematically, if this continues in 1 or 2 years, you're talking about almost a 20% hit to the taxi fleet. So why is this happening? I think Grab Taxi has been very aggressive in the market. So you look at the numbers, they lost 200 over drivers, and then coincidentally, Grab also got secured 200 over drivers for the quarter. So what is for the last 3 months? So what is happening is that Grab is actually giving very aggressive incentives, almost 15,000 kind of sign-on bonus if you join in. So that is really having a lot of taxi drivers shifting. This one not much. This one is just to show you the street hailing, less people use the blue line, and then more people using the app. I think this one I need to say. I mean, everybody's doing that. Next slide. Move on to a Singapore weekly. Okay, nothing much here. Retail sales is down, but because it's Chinese New Year. Construction award. This is a very volatile number, so sometimes can jump 100, but it was down 70% in January. So everyone's waiting for the mega T5. Construction payments, that means actual work done continues to be healthy, about 8-10%. So this will drive building material demand, because when because when you award, it doesn't mean anything, but when you start to do the work, of course, then that's where the building materials like Pan United and BRC Asia will benefit. We saw the numbers, UK payroll, the US payrolls are down. I won't run through this. Yeah, next slide. Okay, so of course, our tactical views, the worst case scenario is panning out. I think energy markets, I think we have a table later, jumped 30% in 1 week. Gasoline 20%. Jet fuel even worse. Jet fuel is up 70% in just 1 week. Tanker and also shipping rates are also up almost 54%. So what's the implication? No one's immune. Of course, Asian economies are very exposed. Like I think Philippines, Japan take 90% of their crude from the Middle East. But because I think Japan is rich, so they have a strategic reserve of almost 200 days that they can cover. Everything is going to be impacted. Expect all goods prices to be higher, because transportation costs will be higher, power, electricity costs will be higher, food costs will be higher because of fertilizer. 1/3 of it comes from the Middle East. Even semiconductors are impacted, because 1/3 of helium that is used in semiconductor production is also impacted. So what are the tactical winners or hedge? Of course, the biggest hedge is just going to keep cash, but a bit precarious, because this thing can change overnight. We'll mention a bit later. But some of the sectors that can benefit is, of course, the oil and gas service providers. We have a table later, and then shipyards, equipment makers like Nordic, rig owners like Keppel, tanker owner like Yang Zhejiang Maritime, gas trading and so forth. Even exchanges will benefit. The structural winner we still think will be ST Engineering. Because after this episode, I think all Middle Eastern countries are going to arm themselves, because I'm not sure how much they can rely on the US to protect them. So, and the Middle East is ST Engineering's biggest, I guess, international market. These are the key events to watch. The key one is the inflation number, but I think all these are moot. I think nobody will pay attention because all price is up, so everyone will be looking forward. Yeah. We also have land lease, I think, tomorrow or the day after tomorrow for webinar. Next slide. I won't go through this, but the one on the right here is just construction. You notice the blue line, construction contracts awarded coming down. But this is very volatile. I think once the T5 come in, this thing will just spike up. But the red line is just an indicative of the demand for building materials. So that is still growing well. Next slide. I'll move on to payrolls and so forth. I won't run through this, I think. Yeah, next slide. Okay, anyway, we also come up with a monthly. I mean, not like I got nothing else to do. I think got this monthly report I have to do anyway. Next slide. Okay, anyway, the key highlights of the monthly. So for Singapore, I think last week we showed you all the data, the performance. But anyway, just a reminder that the February was the 10 consecutive month of gains for the STI. It's a record. I think the previous record was 8 months. So we had 10 consecutive months of gains with the rise in February. Of course, I don't think much is going to get a gain, but the shipyards are the ones that did very well, and REITs were the laggards. So the outlook is, of course, the price of all goods will rise and so forth. We think emerging markets will be the worst. I think like you're talking about countries like Indonesia, Philippines, because they are the ones who will be the least able to afford the high inflation, like Thailand and so forth. So the recommendation is that the pain we think is felt on both sides. That's why we said symmetrical pain. And but of course, rising oil price and inflation is not going to be a good backdrop for Donald Trump when he enters the midterm elections end of this year. So for us, we think it's a precarious. You want to be very bearish, sell everything and so forth, because we worry that overnight, the U.S. administration could just declare a victory. So far, he doesn't seem to say anything. So far, he seems to say that the oil price is still okay. But just one tweet, thank you very much for your attention, and then everything could kind of unravel. So it's a bit dangerous for us. I mean, to be a bit too excessively bearish because these things can change. Next slide. This is just a reflection of February performance. Banks were lackluster on your left. Then yachts were the ones that did well. Yang and Keppel and Seatrium. Not Keppel. Keppel is not a yacht. REITs, of course, got punished last month. And then the property stocks, like what Darren mentioned, are still resilient. Next slide. Okay, so this is nothing much. This is just to show you the big change. I mean, we all know. So it's not only to the gas Brent crude that you see 28%, of course now higher, 110. Coal prices are starting to move. Palm oil price, gasoline, jet fuel, LNG. Dirty tanker means to carry the crude oil, and then clean tanker means carry the chemicals. And then these are the Asian countries' reliance on Gulf crude and then LNG, 30, 40. So Asia is not immune from this, obviously. Next slide. And then this is just to see the spike in VLCC. We'll explain why the left. So the VLCC, which is the tanker rate spike, and then the price of a tanker also jumped to almost 500,000. The exchange could actually benefit because if you look on the right here, the blue line is a value traded. So a value trader has jumped on a 12-month basis. The last 12 months average about 2 billion a day, but I think Singapore SGX now is trading almost 3 billion or even 3.5 billion. So this will benefit SGX because of the high volatility. Not to mention their derivatives, the one we don't have it here. Next slide. And then, okay, so these are just in general the beneficiaries. Of course, oil and gas services will come with a lag. I mean, if oil price continues to be high, they will demand more offshore support vessels, like AHTS, so your Pacific Radiance, Mako, and even Namcheong. Shipyards may do well because they will demand more tankers. Seatrium could do well because after this episode, I think a lot of oil buyers will try to diversify if they can to Brazilian oil. But of course, all this not so easy. Depend on the refinery that you have. But then, of course, Seatrium's biggest customer is Petrobras, so this should benefit them. Yangtze Shipping, which we'll do a flea on ground later, but Yangtze Shipping could secure more tanker contracts if the tanker price is up. But they are more dependent on containers. Equipment makers like Nordic can benefit from this because of they are doing components for FPSOs. So FPSOs are like a floating production unit. It's like to produce oil, but this is a floating. And then rig owners, as you know, Keppel has 4 billion of rigs, which is considered non-core. So the higher the oil price will benefit them. Yangtze Maritime, they have 50 over vessels on order, and then quite a number of them are tankers. So they'll get a windfall. I mean, if the tanker rates continue to be high. Sembcorp Industries mentioned their Middle East water desalination plant is not affected, but they can benefit a bit from the gas trading. They do gas trading. Commodity producers like CNMC and Geo Energy, because coal price start to rebound, and then of course SGX. Next slide. Okay, this is it's not Yangtze Financial. Sorry, this is Yangtze Shipbuilding. Sorry for the typo at the top. So just to give you a sense of what happened in the analyst briefing, because I think most do not get the chance to listen, but just to give you a flavor. So Yangtze, they do shipbuilding mainly in China. They also have a fleet of dry bulkers. So the results was the earnings jumped 30%. The one to watch is, of course, you look on the right-hand side is the new orders. So the new orders, they got the super Hong Pao draw winning bet on the 2024 because they got this 15 billion of new orders. 2025 was less, but 2.5. They're still guiding of 4.5 billion orders, so they're still positive that they get orders. And one thing negative is that the selling prices are coming down because there are more and more new yachts coming out in China. But their margins is exceptionally high. You look at the bottom table, their margins are like 35. So 35 is not a manufacturer's margin, it's like a tech company margin. So, but they said that they also admitted it's unusually high, but it can remain this way until 26, 27 should still have very high margins. They are looking for a replacement cycle in containers. And then so they are focusing on containers rather than tankers. But in conclusion, I think the earnings visibility is strong for them. So if you look at that, their shipbuilding revenue in US dollar maybe about 4 billion. They have 22 billion. So 27, 28, 26 to 28, they have probably good revenue visibility. So some investors might buy into this because there's good earnings visibility. Their dividends, they're paying out 50%, so about 4-5% yield. And they are still going to get some orders according to them because they think there's a replacement cycle coming for containers. So the outlook still looks positive for them, especially the earnings visibility, and they're trading like 11 times PE historical. Okay, I think we can move on to Q&A. Thanks.
Yeah, let me take on some. How is UIB compared to their main peers with diversified portfolio? Better to buy before IPO or close or after? So this is similar to another question that's in the chat that I think CK asked. Price will dip below. What are the chances that the unit price will dip below IPO price of 88 cents in the future? Given, yeah. So during the presentation earlier, I gave a bit of my take. So I guess I compared it to the closest competitor, which is still AIM's APAC REIT. AIM's APAC REIT, looking at the forward FY27 yield of about 7% compared to now. The UIB is expected to trade 88 cents, which translates to about a 7.8% yield. Price to NAV wise, AIM's APAC is about 1.2 times. UIB REIT is about one times. So UIB looks like it's a cheaper play compared to AIMS, which is the closest peer. Yeah. But then again, it's really hard to say because after the IPO it is possible that if the price goes up, then a lot of these initial investors will start selling off or try to flip. So yeah, I can't really comment whether the price will come or not. It's really hard to say. Yeah. Yeah, that's my comments. How will the DPU be impacted by the recent disposal of the property by AIMS APAC? Yeah, so it's a small property, 15 million. We don't exactly cover AIMS APAC, so I didn't really do the numbers, so I don't have the accretion or dilution for that particular divestment. Yeah, apologies for that. Yeah, I think that's all from me. Hand over to my colleagues. Thanks.
Hi, I can take on some questions. Soilbuild's order book declined 15% year on year. Would this be a concern and why a buy rating? I don't think it's a severe concern because I do see it more of normalizing to previous trends because the PSA supply chain contract which they won, which is 600 million plus, is exceptional. So now it's more like normalizing down to about I think going forward the normalized order book we should expect is about 800 million to 900 million, about that range. So that still supports their annual revenue, which is about 500 plus million. Yeah. So going forward, we do still see demand for contracts in terms of the private industrial sector. So talking about, for example, some industrial statistics like JTC, they increased their planned industrial space for the first time since fourth quarter of 2024. So we do think that this is a positive sign whereby JTC sees demand in terms of the private industrial sector. And also Singapore government raising the budget for the research and innovation enterprise grant. So we do think that Singapore government has an increasing it inclines to setting up Singapore as an advanced manufacturing hub. And we do think that EDB will bring in more of these high-end semiconductor companies to set up their manufacturing facilities, which will benefit Soilbuild. Yeah. Sorry, the question jumped. Any short-term risks for Pan United and CSE Global? I can answer for Pan United. So Pan United, their depreciation expense increase. So this will, I mean, in the short to medium term, this will impact their profit. But in terms of their margins, it is still increasing because they are still seeing margin expansion. Because of increased operational efficiency, because they use their in-house technology platform to experience some operational efficiencies. For example, like they can use the technology platform to reduce truck queuing times, and so this reduce their costs in their operations. So in terms of the depreciation expense, we do see it going forward increasing. We do see it increasing going forward, but this is because they have also increased their capex to consolidate their batching plants in Jurong Port. So because of this consolidation, it also increases their moat, and it also makes it harder for competitors to enter the market. Yeah, so in the long run, it is positive for Pan United. Yeah. Will Pan United profit be affected by higher energy costs? I think indirectly, because of the higher oil price and because of the Iran war. Yeah, so there may be a short-term impact. Yeah. However, we do see their growth still healthy going forward because of like what Paul mentioned, the progress payments increasing about 10% year on year, and this shows that the construction projects are being executed in Singapore, and we do think that will offset this temporary spike in oil prices. Yeah, I think that's all for me from now. For now, I'll hand over to my colleagues. Thanks.
Hey, thanks, Ivan. Yeah, there's quite a few questions. I think a couple of questions on the banks. Let me just go through them. Okay, the first one, I think two of them are quite similar. So this one's in the view of the Middle East situation, which of the three local banks has the most exposure to Middle East? Who has the highest risk of additional provisions? Any risk to capital returns commitment? Yeah, good question. So none of them actually have direct exposure to Middle East. Yeah, I mean they have some. They put others, but no, I think they don't have any direct exposure to Middle East. What would probably be the one that we should look out for the most would be they might have some. I think they have some presence in Dubai, DBS and OCBC, but those are really in private banking and wealth management. So it's not like they have loan exposure to the Middle East. So I don't think there would be really any risk of additional provisions on that front. But there might be some risk of additional provisions, because like what Paul did mention earlier, it will affect globally. So a lot of the SMEs, I think, will be affected, might be affected quite a bit more. So you say relatively, I think UOB would have the highest risk of additional provisions. But I think they had some good foresight because they did add on the additional provisions in the third quarter, right? It couldn't come at a better time. So I think that 600 million did buffer quite well for them. Now their their coverage ratio is at 100%, just below 100. So I think that will be enough for the near term at least. Any risk to capital returns commitment? No, I doubt there'll be any risk to the capital returns. Firstly, because both OCBC and UOB didn't really extend their capital returns plans, right? They didn't put in more or give back more, right? They're just giving back, committing to what they have already committed to, right? So that's that money has already been set aside for both OCBC and UOB. And yeah, I think it's below 1 billion for each of them, right? So they have more than enough excess capital to cover that. Even after giving back everything, they will still have about 0.5 to 1% of CET1, which equates to a couple of billion for each of the bank. right? So I think there's no worries on the capital returns for them. For DBS, because they have committed to a lot more, but if you look at the amount of capital that they have also, it's more than enough. So I think they will continue to give back. Yeah, just to take note that this money has already been set aside. It's not like it's coming out of future or future earnings. It's already been set aside. Like this sum has been set aside to give back, right? So I don't think there'll be any risk to capital returns for the three banks. But saying that, right, there now because when we look at OCBC, we are saying that they have such a huge buffer in terms of CT. It might slow down or it might prevent them from actually committing to even more capital returns. So whatever they are committed to, I don't think there's any risk. But additional and future capital returns, then we might see a bit of pullback from them. Right? DBS really committed to all the way until 2027, so I don't think there will be any difference or change in that. But for the other two banks, right, especially for OCBC, where we might see some, they might not be so quick, right, to commit to even more capital returns. I mean, even from hearing from what the management has been saying, right, you can sort of sense that they are preferring to set aside the excess capital for any potential M&A, or to spend that capital instead of just returning it back to shareholders. Yeah, there's also one question about any update to the TP. Yeah, no, we don't have any. We are maintaining our TP for the three banks. Yeah. Yeah, so from there you can sort of figure out what is our the target price for the bank. So whether or not it's a good time to enter, because I think there was one question asking whether it's a good time to accumulate. One more question here. Let me see whether I can find it. Yeah, there's one here about how the surge in crude oil price, right? Any impact, upside, downsides, especially on the NIM and outlook and future earnings on the Singapore banks. Yeah, so with the increase in the crude oil price, right? I mean, overall, right, we will see that there might be instead of easing or like even more easing in the rates, right, there might be a hold off. So we might see higher for longer rates, and this is beneficial for the banks, but it will be more of a longer term kind of thing. So if it extends further, right, we could see that the rates will not ease as quickly as we expected, right, or as the banks expected. So what we could see is that there could be some positive impact on the net interest margins, right, and also DBS, I guess, will be the biggest beneficiary of this from the upside in higher for longer rates, right? I mean, also both OCBC and UOB will also benefit from this. And another thing also would be the non-interest income. We could see higher volatility and also higher inflows in wealth management as well as AUM. But I guess the biggest downside, right, would be the asset quality and credit costs, which I mentioned earlier as well, right? Especially for UOB, who are still very heavily based, their loan book is still SMEs, right? We could see some squeeze there, and possibly higher provisions. But the plus is that they have set aside quite a huge sum of around 600 million. So I think that will be more than sufficient to cover whatever uptick in NPLs or provisions that we see. But I think it will not be direct exposure that will cause this uptick in NPLs or increase in credit costs. Yeah, so overall, I would say that it's still quite stable for the Singapore banks. I think their earnings are still quite stable. We won't see very drastic increases in PATMI for 2026, right? We might not even see any increase. I think it'll be pretty flat. Might have some uptick, if fee income comes in stronger than expected. But net interest income is still expected to decline slightly. But if the rates really do stay higher for longer, then we could see that being the switch where we see net interest income actually coming in higher than previous year, which was 2025, and that could cause that slight increase in earnings in the bottom line. Yeah, okay, I think that's all for me. See the chat. Q&A. Yeah, okay, that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
Yeah. Okay. Yeah. Thanks, Glenn. So let me just read up from Mr. K. I think in view of the Iran war causing the oil price to spike, which are the stocks that will be severely affected and which will benefit from it? Okay. So the most severely affected is of course airlines. So airline stocks are the ones that has been hurt the most. The beneficiary, I think, like someone mentioned, would be the oil and gas producers. Like Rex and of course RH Petrogas. The reason why I didn't add it here into this list is because uh, they got no real company updates from them. So at least all the companies here I've at least met before, I've seen before. At least I have some rough gauge of the outlook of the company. So for Rex, I really no clue what's going on there. Yeah, and of course to buy now is at when oil price already 110 to go in, unless you're making the big assumption that things will persist. This high oil price will continue for some extended time. If you take the more contrarian view, then I guess airlines will be the one to take the bet on, because they're the ones who drop the most, or maybe will drop even more. Yeah. So if there's a overnight reversal, then of course airlines will be the player. From Lin, will palm oil and related businesses benefit from the oil crisis? Palm oil can benefit especially through the biodiesel. So if diesel prices spike up in Europe and globally, then the transmission will be from the biodiesel. So there'll be more biodiesel demand in Europe, which will support palm oil, and more demand because it's cheaper. And also in Indonesia, because Indonesia didn't go through to the B50 from B40. Pini, because the fund that they have is running out because they have to subsidize, because at that time palm oil price was higher. But now that diesel price is higher, the subsidy will be less. So I think palm oil can benefit from all. Coal will be a bit more indirect. I mean, if there's a disruption to all them, then they will probably need more coal to produce electricity. So that will be a bit more indirect. Yeah, and coal ultimately it all depend on China. Yeah. So sorry, there's no TA because Zane is on leave today, so apologize. Geo Energy recently proposed a 15 million share placement. Can you share the stock? Okay, I was a bit surprised the share placement because my expectations was that they will probably do a deal on selling the toll road, selling a small stake. Of course, it's a positive. I mean, they raised cash and the share price is about 42 cents. So I guess I'm a bit more neutral on it because I was expecting them maybe closer to June to do a better deal because when the road is more completed. But maybe they just needed to raise just in case because they have to leverage up to buy the road. There's no report out yet because they're only doing a briefing on I think Thursday. Yeah. Will the middle okay? This one I asked. This is a set question. Any short-term risk for PenU and CSE? I think let me just answer this for Yigban to clear this. So for PenU, no. I think actually construction activity. I don't think the government's going to stop construction work on the airport because oil price is higher. I mean, after all, the government got so much surplus, right? And I think the demand will be even stronger this year because there's more completion work, like we mentioned. CSE Global unlikely. Indirectly, they may benefit because they do have some shale oil exposure. They do have a bit of shale oil process equipment that they sell, or control equipment. Sorry, not really process equipment. So the impact, actually CSE could be a slight beneficiary because they are exposed to shale oil in the US. Oh, is there a swap of target price and last time? Yeah. So sorry if I make an error there. Yeah, sorry. Yeah. Because sometimes because we do this rarely at night sometimes, so it's apologies for the mistake. For ComfortDelGro, decline in Singapore fleet might not necessarily be that bad. If earnings in the UK can continue to rise. Not necessarily because the taxi business in Singapore is a very profitable one. I think that's why Comfort before Grab came, Comfort was trading at high multiples because this is a rental business. So if you lose one taxi, it's pure profit. So maybe you rent the taxi $100 a day, then you overnight you lose this customer. You really lose $100 earnings directly. Because now this car will be idle, and then so the impact is actually I think much more severe for taxi because of the rental income, which is a pure profit business. Yeah. Good and bad now. Of course, when it's going up, then it's pure profit up. Any further upsides on my target price? I believe for ST Engineering the release it is about $13. Yeah, no change to that. Yeah. Thanks for the question. Yeah, there are some TA questions. Yes, yeah, sorry, we don't have any TA. Why are Paul? Hi, Paul. Why Rex and RH Petrogas not on your sector beneficiaries? Yeah. So, sorry, just that I didn't meet them. I don't have. I know they are all producers. No, one is RH Petrogas is even better as onshore, but just that we didn't really meet them, so I didn't really want to put anything. We have no visibility what's going on with the company. Beneficiary Pet Radiance. Yeah, Pet Radiance also no report because they are still waiting for the analyst presentation. It's going down because I think everything is going down. So yeah, so not only this them. Yeah. Hi, can you show the beneficiaries? Yes. Okay, can you comment on about PropNex? I think we already gave that, and Beher, I think I leave it to Yikban. The the high dividend payout by Comfort is one-off or continuation? Yeah, it is not one-off. I think they can continue. They unlikely want to bring down dividends. I think Comfort track record is they're quite they are quite conservative on dividends. And the big capex that they did was in Manchester, and that is over. There's another question from CK Lai also. I think he's in Kathmandu now, I think, on the chat group. So he says SBS Transit lost 2 major bus packages, but still paying out great dividends, which include a big special dividend in fourth quarter. What is the purpose of this special dividend? Is what SBS Transit doing now sustainable? So SBS Transit, for those who don't know, they run the MRT lines and the bus. But the reason they are paying dividends is because I guess they want to upstream it to Comfort. So although Comfort has, I don't have the exact number, maybe about 100 over million dividends, but most of it is trapped in SBS Transit. So SBS is paying the higher dividends to, I guess, upstream it to Comfort. Yeah. Okay, I think I will pass. Can you give your opinion on Yang Zhejiang Financial's future? Okay, the affiliate on the ground just now that was on Yang Zhejiang Shipbuilding. Yeah. For Yang Zhejiang Financial, I'm not sure if Glenn has more to add, but I think it's pretty grim because their NPL is 40%. So yeah, so I'm not sure how they're going to get people to pay them back. And most of the loan book is in China. They're slowly trying to bring it back to Singapore, but I think the outlook is pretty grim. But I haven't looked at the most recent numbers. Maybe Glenn can discuss. Yeah. Paul, your beneficiary list, Yang Zhejiang Maritime, what sort of benefit can they get? What about Yang? So Yang Zhejiang Maritime, you can think of them like a ship. I wouldn't call it a hedge fund. You can think of it like a fund that invests in ships. So they have ship and they have about 50 over vessels on order. They don't disclose how much is tankers, but I think the large portion tankers. So if tanker prices go up, then they benefit. So and they don't want to operate these vessels. They are more like a owner, so they don't mind flipping some of these vessels. So they benefit. Yang Zhejiang Financials, no, Yang Zhejiang Financials just lending out money in China, which is going to get hit badly. So for Citrum is FPSO and rig. I'm not sure there are any orders for rigs, but they are FPSO beneficiary, and they are especially to Petrobras, the P series. So they will benefit because in two ways. Of course, the oil price higher, customers will want to order more FPSOs or even rigs. And of course, when oil price higher, they will also want more renewable energy for energy security. So the customers will want more renewable power, offshore wind and so forth, because if you can't rely on Middle East oil, you better build up your renewable energy, I guess. Okay, I hand up to the rest, Hashim, to answer some of the questions. Yeah, thanks.
Yep. So I'll answer some questions. So will the Middle East war be a headwind to SATS earnings and future outlook? So definitely there's going to be some impact to SATS. It's exposed to the air transport industry, but when we look at their contribution to earnings, so Europe, Middle East, and Africa combined makes up about 20% to revenue in FY25. And we think currently, compared to their total revenue, it's a smaller portion. And we think that in the Middle East itself, Qatar Airport has been partially reopened. And given that SETS contracts are not just tied to the customer themselves, it's tied to the global network. So if they have a tie-up with, say, Emirates, they will be servicing Emirates in the different countries that they are in, not just in Middle East. So in that outlook, we think it might not be as affected, and it depends on how long the war is going to be going on for. So right now, our stake is that likely it wouldn't be as affected at the moment. Then next question is, what's your outlook for gold price? Will it continue to rise? So we are bullish on the gold price, given that our target price for CNMC is moved higher. It's currently $2 plus $2.34. So we are bullish on gold price because of the first of all the war, and secondly, the UAE is one of the largest refiners of gold, and given that there is a disruption, and given that most of the refined gold is flown through the UAE by air cargo, there might be some regional disruption which can lead to an increase in gold price. Apart from that, we are also observing that China's treasury has been continuing its month-on-month purchase of gold. So we are bullish on gold price, and we think it will continue to rise going forward. I think this is on REITs. I will try to answer, then I'll leave it to Darren to add on. So with sticky inflation from Middle East war and surging energy prices, will it be negative for REITs, and will it be less likely for a Fed rate cut? I think the case for a Fed rate cut depends on a few things. First of all, yes, Middle East and the increase in oil prices. But we also observed that the jobs report indicated a softer labor market. And it ultimately depends on whether it's a higher for longer oil price or whether it's going to reduce. Previously, I think we shared that with the midterm elections coming, Trump wouldn't like for inflation to be high, and oil price has a large impact on inflation. So if Trump declares overnight victory, will we be seeing the same impact on oil prices? Likely not. And so inflation might also go down with that. So ultimately, we are still bullish on Singapore REITs. We think that yes, there might be a less likelihood of say 2 rate cuts, but there might still be the case for 1 rate cut going forward, which might be beneficial for REITs. I think that's all from me. With strong USD ongoing, while gold price will be going down. So gold price did go down. It went down about 2%, and that's because the case for rate cuts has reduced. So if there's a less likelihood of a rate cut, people are going to be putting their money into, say, US bonds instead of gold. So right now, I would say it's really uncertain. 2% decrease doesn't really affect gold prices in the grand scheme of things, and we have to take a wait and see approach. But overall, we are bullish on gold price at the moment. I think that's all from my side. I will leave it for others.
Yeah, sorry, just hop in on some questions for me. Can I comment on WeHer? And I think there's also a question in the comments. I mean, in the chat. Why WeHer price keep plunging? Yeah, so for WeHer wise, I don't think that it is short-term sentiments and profit taking, because I think in January itself the share price went up, spiked up about 25-30%. Even before earnings even released. So I think there's a lot of expectations being priced in. However, for their earnings, they did well. So for example, if we adjust out all the fair value and all the one-offs, their net profit spiked by 130%. So this is being driven by their property development segment, construction segment, as well as worker dom segment. So these three contributed largely to their net profit spike. And going forward, their construction order book is still strong. There's still about 600 plus million order book in construction. The HDB BTO has not started yet, so we do see progressive payments from there. Worker dom wise, this year we are expecting a 60% increase in bed capacity. The beds are already in operations. So the occupancy we do expect it to slowly ramp up throughout the year. Yeah, so the increase, the 60% increase, you wouldn't see it directly in the first half results. But maybe if you are doing a modeling, you should model it throughout the year itself. They are saying that during the call, they are saying that the application rate is there. The demand is high for the new Pioneer Notch accommodation. And I think from the earnings call itself is also quite positive in their tone that they are engaging with JTC in terms of the lease extension for their Trustville dormitory, which is the 16,000 bed worker dormitory. Yeah. So the lease technically will expire this year, but they are already engaging with authorities, and that is a good sign. And I do think that because of the large projects coming in and progress payments, I mean like construction projects being executed, we also think that there's a high chance that Singapore government will not just let these 16,000 worker dormitory accommodations lease expire. Yeah. So if it expires, there will just be 16,000 workers left in Singapore without any beds. So I don't think that's what the Singapore government wants. Yeah. So we do think that there's a high chance of this extension. Yeah. So I'm still working on the report. Once it's released, I'll update you guys. Yeah. Thanks. I think I'll answer on the Food Empire question as well. Yeah. So any thoughts on Food Empire? Do we expect earnings to be impacted by the Middle East war? Yeah. So we don't cover Food Empire, but I attended their earnings call. So I do think that Food Empire has a very resilient business in the sense that previously their core business is from Russia, as well as and they also have a big part of a small part of the business in Ukraine. So even with the Russia-Ukraine war, with coffee prices spiking up, they are still able to pass down this price spike to their brands itself, and so they are able to maintain their margins did not drop that much. They are able to pass down the coffee prices, and they have also survived the Russia-Ukraine war. So I think even with the Middle East war ongoing, I do think that even if there's an impact, it will be a short-term one, because I do think that their brands have they have very strong brands, and they are able to pass down any price increase of coffee or commodity to their customers. Yeah, I think that's the short comments for Empire. I think I'll hand off to my other colleagues. Thanks.
Thanks,
Yeah.
Evan. Yeah. Well, let me take this one question first. Yeah, it's asking about how would the war be negative or positive for insurance companies like Great Eastern. Yeah, so good question. Both it's double-edged, right? Like the banks, right? In terms of there will be positivity because of the higher for longer rates. So that will be positive for their fixed income portfolio. That's their core business. But you must also see that there will be some downside in terms of the volatility, because there'll be some mark-to-market volatility. So we will see some loss on their equities and also alternative investments that they have in their shareholders fund. So that will be something that we'll need to balance out. Yeah. So but I think long-term wise is more of a positive, similar to the banks. But you just have to withstand that volatility near term. Yeah. And yeah, regarding the other one on Yangzijiang financials, yeah, I think just to add on to what Paul has said, yeah, the 50% NPL ratio that they have is very it's quite a negative lah. So it did increase from like 43% to 47%. Now it's at 50% NPL ratio. And also in the most recent not wrong, the most recent FY25 results, they did have a loss of around $5 million there because of the higher allowances that they have of about 290 million. Yeah, so I don't think it's like what Paul said, it's quite grim. Yeah, from the high NPL, higher allowances, and also the net loss that they're having. I think that's all I have. I'll hand it back to you, Paul. Thanks.
Yeah, maybe they're good in many things, but we're not lending money in China. Yeah. I don't know what they quote me like that. Yeah. Also, any thoughts on Wilmar? Do you expect earnings impact? Okay, so the impact for Wilmar is really going to be indirect. Like we mentioned, there's a case for higher demand for biodiesel, and also there's a case for higher palm oil price because I mean, this is just on paper, right? So fertilizer is down, so production, if this disruption continues, then of course production for palm oil is affected because they rely a lot on fertilizers. And also the second thing will be, of course, the higher biodiesel means higher demand for palm oil, higher demand for ethanol, which will also benefit Wilmar sugar business. So on paper, they can benefit on this, and when there's dislocation, Wilmar also do well in their trading. They do a lot of trading in terms of commodity trading, so that could also benefit their trading business. Again, all this is on paper. I mean, we've no idea this will pan out, depending how long this conflict will last. As Espero Lifestyle is moving to main board soon, is the share price going down due to gold price? In part, but everything is going down. So yeah, every share price is going down. Because when you're rushing for liquidity, it doesn't really matter. Which only the commodity guys like Rex and RH Petrogas are up. There's one more question. I can't find the past recording. What is the link? Yeah, we can't type it. I'm not sure why our typing. We can't type in the chat. But I mean our postings for YouTube is all on the YouTube PhillipCapital channel. We normally upload it the day after the event is done. Last question. Paul, don't approve Zain's leave on Monday. Yeah, this one I cannot do it. Otherwise, the HR will send me a warning letter. I think you got to ask him yourself why he take leave on Monday. Yeah, but anyway, thanks for the question. Yeah, okay. I think we answered all the questions about 30 hours. So thanks everyone for your time and for all your questions, and hope everyone have a good week ahead, and thank you for joining us, and yeah, thanks so much. Yeah, bye bye.